Right, financial instruments, IFRS 9. This is an interesting one. This is new. And sorry, it's not new, but we know this comes out a lot. I've broken it down into cases. When I say cases, just to kind of sort of just simplify it really. Fundamentally, when we talk about financial instruments, we're talking about a situation where you will have a financial asset in one entity and a financial liability in another. So you might have issued shares, or you might have issued some bonds. So you, in effect, you will receive some money and you'll be recognizing a liability. The other party, of course, will be recognizing an asset because money would have left their bank. So it's just really whose side of the coin are we looking at? So the story really opens up with this question of what is a liability, because there seems to be there's been a debate for a long time as to the difference in liabilities and equities. Or when I say debate, you can see why there's a debate, because if you can recognize something as equity, if you can get away with recognizing something as equity when it's liability, well, your ratios look very different. And in a way, you could almost flip the way how attractive your organization looks as a whole. So the standard is quick to clear up the definition of liability. And liability, you actually owe someone a certain amount of money or something that you must pay back to the figure owed. So there is, if you have to issue a certain number of shares, a variable number of shares with your market price to reach a liability owed. So for example, if you borrow 10 million and then you say, I will pay you back a variable number of shares to pay you back that 10 million plus interest. I will keep giving you shares until we get there so that you can sell the shares and get the money. Then, fair enough, it is equity shares you've just offered the person, but it is in effect a liability. As opposed to equity, where if you offered someone a fixed number of shares and you said, listen, I'll give you 10 million shares, well, the value of those shares could go up or down. So the person's fundamentally almost taking a chance, if you like, and they are literally, again, it does fall into the classic definition of equity, literally the residual interest, if you like, in this business, which is, if you like, what is the value of those shares. So that's the first thing, which is why I've called that case one, understanding very clearly the difference between liability and equity and being able to talk about it from the conceptual framework point of view about what a liability is. There being an obligation to pay a certain amount, and you must find a way, even if it's detrimental to you, to pay them back, as opposed to equity, where you're not obliged to pay back this money and you're not obliged to pay dividends during the year, that sort of thing. Whoops, sorry, I don't know what I've done there. Now let's go into case. When I say case two is just the next discussion. And the next discussion pretty much sits around this. We're now looking at the first. I'm going to look at it from the point of view of someone who's issued some bonds or issued a liability. So you've received some money and you're recognizing a liability. Now, typically, most people hold this over the long term. So because you're holding it over the long term, you will pay interest, you will pay back some of the capital from time to time or whatever yearly. It is recognized at an amortized cost. So the conceptual framework says recognize it as this amortized cost, and you just keep paying the money. Under certain circumstances, it is possible to recognize liability for the short term. So in this regard, then in effect, if you like, debit bank credit the liability, but we recognize it through profit or loss. So really, profit or loss, fair value through profit or loss sits very well with the idea of holding something for the short term. Here, you're holding it, the fair value, even if the loan is changing, it doesn't affect if you're holding it at amortized cost, it doesn't affect it, because you just pay back what it is that you've, if you like, you owe at the end of the period. But here, when you're holding it for the short term, we have to recognize it through fair value through profit or loss, because you are open to those changes. You're saying if in the short term something comes along, I will happily sell it or get rid of it. There is I've put a case 3 here. So sometimes you also have convertible bonds. This comes from F7, where we use split accounting. You receive some money, and typically there is an option in there to be able to convert some of that liability to equity. So in effect, what you're really offered is liability and equity, and you have to go about splitting that up, if you like, to make sure we recognize the equity element. So go back and look at that. It's nothing crazy. Just take the liability component and find the present value based on what the interest would be if you were only issuing the liability, to separate that out. And whatever the difference is your equity. So a bit that we need to recognize, right? So no one will give you 5 million if all they're going to be getting back is 4 million with an option. It means you've offered something else, which is equity. So that's that. Now, um, oh, right. Then we now have here. Now we move into looking at recognizing if you were on the other side. So this should really be case 4, but or this is case 2, part 2, but this is case 4, if you like. Now we're recognizing financial assets. So you are the one, you've actually lent someone some money. So you're recognizing a financial asset and you have money has left your bank because you've given someone money, but you're recognizing the fact that you are owed this money. The two things you could have purchased, right? You could have purchased equity or you could have purchased some bonds. If you've purchased equity, typically, if these are listed, you're typically holding them for the short term, for trade, right? So we're talking about fair value through profit or loss. That's the principle. And that's usually the case. Usually you're holding this for the short term. Sometimes you may be holding equity for the long term. So there's an exam I saw a question I saw once where a business had invested in a small limited company. So you were holding those shares for the long term, and just to see because you have that relationship with the organization. So we recognize it as fair value through other comprehensive income. You designate it such way it is that way it is irrevocable. And so any changes here when you now sell will go straight to retained earnings. The whole idea here is that you're holding it for the long term. So we're not really having things go through profit or loss. And any changes are going through other comprehensive income until you dispose, of course. When you do recognize, then any movements will go to retained earnings. So typically with equity, you can only ever really hold equity as fair value through profit or loss or fair value through other comprehensive income because you've clearly designated that you intend on holding these shares um, for the long term. Then we have case 4, where you are, instead of holding equity, you've chosen to hold debt. And there's a bit more creativity here. So here, with debt, we're talking about, you can see I didn't even mention the word amortization with equity. It's impossible. With debt, we can, if you think of a lessor, you're on the other side where you're holding it for the long term, you will receive regular amounts, contractual cash flows, amortized straight away. We have a scenario where you might be holding bonds to sell. You're waiting to see if something better comes to replace them with fair value through other comprehensive income, if you like. And when you have the final movement or any movement or you sell off a bit, then the fair value through profit or loss. Because really, at the heart of it, it's a bit of a short to long term kind of situation, isn't it? But you're holding it to see if something better would come along, where you're replacing things. And we just have your straightforward holding debt for trade, fair value through profit or loss. So when you're amortizing, you can add the other costs to capitalize them. But when you're holding anything in fair value through profit or loss, when I say other costs, I mean your transaction costs. Here, when you're holding things at profit or loss, you're typically passing them through the income statement as an expense. And that's really those are the key cases that you have to be comfortable with dealing with financial liabilities and understanding how to hold them, dealing with financial assets and recognizing the fact that you will have equity and debt or debt, sorry, and then you'll have to think about how you recognize them. So kind of make sure you're comfortable with that. The last, well, not the last, but the other next issue is to do with credit loss. So typically we have to recognize, we have to think, just think in the realms of provisions. You might be holding a financial asset. So this is the realm of financial asset. You've got a financial asset, like all things, it could go bad. So you need to assess. So there's a lifetime credit loss assessment or 12 months. So this is just over the next 12 months, what's the situation? But if I like to think of this lifetime credit loss as more as impairment for the long term. So if there's evidence of long-term risk of the person who we've lent the money to, there's potential they will won't get this money, and there's enough evidence, then we can. What is that evidence? Credit risk. We look at credit risk at reporting date. Are the contractual payments more than 30 days overdue, past the reporting period? Then we if you like, we then recognize the default over the life of the asset. But this is more what we typically do in accounting, where we look over the next 12 months. So we look at the 12-month expected loss. So it's either one or the other. I mean, when I say one or the other, this is what you're supposed to be doing every year. But then if you have this happening, this will override the 12 months. The lifetime will override the 12 months, and you just, as you can imagine, it'll cover the full impairment over the next, if you like, life of the asset. Right. Then we move on to derivatives, which are also financial assets. So you're recognizing these instruments. The good thing about these are always recognized at fair value through profit or loss. Initially at fair value, always recognized through fair value through profit or loss. So whatever calls, puts, share, whatever swaps, all at fair value through profit or loss on their own. Forget hedging now. We're just on their own. If you recognize them, aim is they're too volatile for anything else to really. The nature of the cash flows means that they have to be recognized at fair value through profit or loss. Embedded derivatives. So if you have a derivative sitting within another contract, if that contract would have been recognized under IFRS 9 or as a financial instrument, then just recognize everything through fair value through profit or loss. If that instrument, if so, for example, if you have a derivative sitting within, if you like, a bond, or sitting within equity, or sitting within a type of loan, these are all financial instruments, so it's all fair value through profit or loss. Most of the time, that is the case. If not, you'll have to separate out the derivative from this non-IFRS regulated instrument. And then finally, we talk about hedge accounting. So two different types of hedges. Fair value hedge, our focus is on the actual recognized asset or the liability, right? And what we have to do, so we're really trying to work on that exposure of that asset or liability. So the question here is, where are we currently recognizing that asset or that liability? If we're recognizing it, if it's fair value through profit or loss, it goes through profit or loss. If it's fair value through other comprehensive income, just in the same way, that hedge will also go through other comprehensive income. You're literally following the trail of the actual asset or the liability. So follow the recognition of the asset or liability at designation. The focus is on the asset. So it could be a building, word or inventory. It's currently sitting there. We're trying to make sure we can still sell it in the future for an agreed price. So we have something that we're actually working towards. But typically with a cash flow hedge, what we're trying to make sure is that we intend on buying something in the future. So we intend on carrying out a particular transaction. So we have a forecast transaction and we want to be sure, typically a Forex movement, we want to be sure that we're able to pay for this thing that we intend on buying in the future. That's the plan. So in order to hedge that or prevent that variability, we have cash flow hedges. So because it's going to happen in the future, it might not happen in our own year, as you can imagine. So it must be movements must be recognized within the statement of other comprehensive income because we're waiting, aren't we? So you can see here, it says here, remeasure hedging instrument and hold in OCI until transaction has happened. Right. And then finally, the hedge effectiveness, a number of things I've picked up on here. What you want to do is you want to continuously, assess at the inception of the hedging relationship at each reporting date. So the key point is there must be a relationship between the hedged item and the instrument. Credit risk does not dominate the value changes. And the hedge ratio, hedge item to the hedging instrument. So you can't hedge, for example, if the plan is to buy 100,000 barrels of oil, you can't be hedging 40,000 and thinking you're using that as a hedging instrument for this. No, you must hedge 100 for 100, so to speak, and that's what we mean here by the hedging ratio. We do have scenarios in the cash flow hedge if the gain or loss on the hedging instrument is greater than the item itself. You can recognize that in the P&L. Straight away. But again, I think it's just important to as you do questions, you'll be able to see this pan out. But this is just to make you aware of those issues again. Yes, and I believe that's the end of that of financial instruments.